Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome to the Campus Dialogues, a Muslim Views production in affiliation with MuslimFin. MuslimFin, your roadmap to Islamic banking and finance. I'm your host Ali Sali, and this evening we're going to get a bit of a market update. So there's a lot happening in the world today, and things are happening very, very quickly. So to kind of navigate this, and here to introduce our guest is my good friend and colleague Siraj Buzik. Siraj?
Assalamu alaikum, Ali.
Yeah.
How are you doing?
Alhamdulillah, alhamdulillah.
Good to be back in studio.
Yeah, absolutely.
Before we start, Ali, I just want to, let our audience and our viewers know that, inshallah, my good friend and colleague, Ali, will be leaving for Hajj next week, inshallah. We make that Allah accept from him all his good deeds and accept the du'as made from him and for him and by him, inshallah. Safe travels, my friend. Don't forget to make du'a for us on the podcast.
Will do.
Moving on tonight, our guest is no stranger to our podcast. He has been here before. He's sort of turned into our analyst when we're looking for a market update. And that person is none other than Abdulaziz Davids. Abdulaziz, welcome back.
Shukran. Assalamu alaikum wa rahmatullahi wa barakatuh. And shukran for the opportunity again.
No, we're quite excited. We're happy to have you back. Abdulaziz, the last time we spoke, I think it was 3 months ago, and you gave us a market update at that particular point in time.
Yes.
And I think one of the themes that came through strong was Trump taking office, his slogan of MAGA, making America great again. We touched on what you call a whale, deep seek, as I recall. And I think it was Tesla, Elon Musk becoming the richest man in the world, which coincided with him being part of the inner circle, as we say.
Yeah.
But like Ali said, a lot has happened since then. Some of the tariff hikes. That particular podcast was just before the local budget or the South African budget speech as well. And there was a lot of noise around that, and how that impacted the man in the state or all of us. So, without further ado, I know you have a presentation for us. So we're looking forward to that and some of the insights, inshallah.
Yeah, shukran for the opportunity. Given that it's a podcast and given that it's an evening, I'm not going to bore you with too many facts and figures. I think our audience will get bored. But I think the last 3 months has been very eventful, both locally and globally as well. So what we've done is really 2 slides on the market update. Firstly, the first slide we're talking about, it's a wordy slide talking about what's actually been happening. And to summarize, starting globally, as you've rightly said, Trump took office beginning of January, and he immediately started signing executive orders from issuing tariffs of 10% on China to all sorts of executive orders. Some of them actually quite ludicrous, for example. But I think the nub of it is that we have seen a cataclysmic event on the 2nd of April, because that's the day that he announced the big tariffs. Basically, at that chart, we have big fanfare announcing the whole world being tariffed.
Was that Liberation Day?
Liberation Day. He called it Liberation Day. So, South Africa, we had tariffs of 30%, some tariffs of 45% that he applied. China was a big victim. Initially, he talked about 50% tariffs, and then there was a tit for tat between him and the Chinese. And in the end, he ended up with 145% tariff on China. And China reciprocated with their own 100% tariff on American goods, basically doubling. Now, they say when the elephants are fighting, it's the ants that are getting injured. So South Africa being literally an ant compared to these large economies, we are getting hurt. And we'll talk about the impact, the real world impact of these tariffs in a minute. But from a market update point of view, what we have seen is markets drop between 10 and 15% on the 2nd of April. It was a big event. It's not as massive as COVID, if you remember March 2020. But that day, markets, it was like a bear market. It was a kyk weer, as they say in Afrikaans, of March 2020. And for us, what we then did is we did a lot of, and being students of the market, it's important to reflect on history. And we'll talk about some of the reflections that we did at Commercial Asset Management in terms of looking back at the past and seeing the impacts and how that unfolded. But coming back to the market update, initially we thought that markets would continue to decline. What has resulted in the recovery in the market is that Trump has walked back some of these tariffs. So he's already put at a 90-day sort of moratorium or pause, as he calls it, on some of these tariffs. So we have seen a market recovery in response to that. And even with China, as we speak, there's now talks planned for this weekend between the Chinese and the Americans. So a lot of the extreme negativity has dissipated somewhat from that. So I think we are in a position now where the biggest sort of casualty from a global point of view has been global growth. And we'll talk about GDP. We've also seen oil prices coming down quite dramatically, and that's because of the fears around global growth and also OPEC increasing production, which we can talk about. The other big impact has been on the gold price. And I know we spoke about the gold price briefly last time, and the fact that my personal view was that the gold price was going to go higher in the short term, but there are potentially headwinds for it to go meaningfully higher to the same extent as we've seen over the last 18 months, and we can talk about that as well. But in essence, the gold price has breached 3,000 and is now sitting just under $3,400 an ounce. So where it is currently, I mean, there are some market commentators that are talking about $4,000. I mean, that is a prospect, especially if we see, I mean, overnight we saw the tensions between India and Pakistan, for example, again coming to the fore. Both of them have nuclear arsenals, so that could, if it's not contained, could be quite significant as well. So there's a lot of geopolitical issues and tensions. We know the issues in Gaza and the Middle East. The fact that the Yemenis and the Houthis, as they call it, have been able to strike Tel Aviv and the airport there. That is a significant development as well. So all of that plays into the gold price, and it also counterbalances with what the outlook is for the oil price as well. So I think those are the big sort of themes globally, which we can maybe later on unpack as well. Coming back home, you said the last time we spoke was before the budget. We are still before the budget. Where we are now, we still don't have a budget. So I know it was budget 1.0, then budget 2.0. We're waiting for budget 3.0 now. So hopefully that gets tabled, I think, in the next week or so. And the big issue was the VAT increase, which initially they tabled to 1%. They walked that back to 0.5%. Even that, the courts has got involved in it as well. And I think that the big silver lining from all of this is that the courts have basically said there needs to be greater consultation. And I think 30 years into our democracy, 31 years now, the big sort of opportunity we have is that there's a real opportunity for us as consumers, for us as taxpayers, to have a say in the budget. Because either via the multi-party sort of GNU or actually directly as well. Because the big victory for consumers and taxpayers is that the minister has been told that you cannot submit a budget, especially if there's tax increases, without proper and due consultation, especially with stakeholders. So I think that's a big victory. Look, I don't think that we're going to have significant changes other than the 0.5% that will probably be dropped. But SARS has already said that they'll be able to collect 70 billion over the next 3 years just through more efficiency, which I think is a fantastic outcome. I mean, the reality is that if we have greater compliance, there's less pressure on the existing taxpayers that do comply, because then there's scope for real reductions in taxes as well. So from that point of view, I think that's quite positive. My big worry and concern at the moment, and I mean, the question we always get is what keeps you awake at night? What keeps me awake at night is the real impact of tariffs on the South African economy. And again, we've done a deep dive in terms of the makeup of the South African economy. If you look at our economy, $400 billion, the bulk of our exports is basically two things. It's citrus and agri from the Western Cape predominantly, and then BMW X5 or X3s that goes to America and Australia. So from that point of view, I think, it's a very narrow field, so we should be able to navigate around that. And lastly, to round off the market update, sorry, it's a long sort of monologue here, but the market actually went down 2nd of April and it has recovered. So the JSE is up about just under 10%. The Rand is actually strengthened. If you remember, the Rand went to 1970. Almost 20 Rand, and Ali was going to feel it when he was in Saudi with the Rial as well. But we're now sitting at 1825 to 1830. And the main reason for that is that we've seen a real weakness in the dollar. So my personal view is that Mr. Trump and his Doge colleagues, Mr. Musk and others, they are actually weakening the dollar. And that is beneficial. So it's nothing to do with South Africa or that we suddenly better or what. The dollar is weakening against most currencies. And the reality is setting in that the world, that the US is not the best investment destination in the world. And I think that's a big theme that we will unpack and that will evolve for the remainder of the year. Because where we are now, most fund managers, most indices, most sort of anything that you look at that has a global sort of investing strategy actually has a substantial amount invested in the US. Between 60 and 70% of all funds that are invested globally is invested in the US. And we think that that needs to change, and that will change dramatically. Already we've seen Asia pulling out billions of dollars out of the US economy. We've seen China reducing their treasury holdings, US treasury holdings, from 2.5 trillion. They're down to below 1.5 trillion. They've effectively, and that's also why the gold price has gone up, because they've sold US treasury and bought gold. So I think those are the big themes. We can unpack them at your leisure, but that's where we are currently in the market. Shukran.
Wow, that was a lot. So where do I begin? Okay, let's start off with obviously the tariffs, because everybody's been talking about tariffs all you hear about when you turn on your television nowadays is tariffs, right? I spent some time in the US, and I got to see Donald Trump on a few TV shows. One of them being, I think, what was it, The Apprentice?
Okay.
And but Donald Trump has always had this, kind of bombastic way of negotiating. He calls himself a real estate guy, and he always tends to go in hard. So I noticed that's the way he kind of does makes deals. He goes in hard, tries to push for as much as he can, and then tends to pull back. And it seems like that is what he's doing with the tariffs. And he always tends to pull back, and then he feels like, oh no, he ended up getting a deal. And then he'll just say, okay, well, that was the best deal possible, right? So you mentioned that the US and China are potentially having talks now, because obviously that the two largest economic powers in the world are now at war. If you want to call it a trade war, it really is a trade war currently. And that is very concerning for the rest of the world. Like you said, the two elephants and then the ants getting hurt. So do we see, because we have two strong men now, both Xi and Donald Trump in power, and neither of them domestically can be seen to be weak.
Exactly.
So do you think that the one is going, who's going to back down first, and what does that look like for the global economy?
That's a very important question, and while I talk, hopefully the viewers can see the slide. We've got the slide there where we've got the bubbles and just the flow, because I think that contextualizes where we are in the world. The two biggest economies are actually the US and China. But what many people don't realize or appreciate is that the China economy is the biggest exporter in the world. So China, if you look at that bubble slide, that one. That one actually just signifies that, China, you've got that sort of that red bubble in the center
so
there.
we'll just pull up that slide here in just a minute.
I think it's the 2 slides down from this one. After that one, that we spoke about the market update and the market movements. That
there
one.
You go.
So maybe just one
back.
So if you look at that bubbles, so you've got almost a perfect counter for China on the right hand side, big exporter, and then the US. The other big bubble is the US. So the size of the bubble is basically an indication of the size of the exports. And so the US imports a lot from China, and then it exports to other countries. So it's a symbiotic relationship. And in our research, we did a big deep dive into global trade, as I've mentioned. And what we've discovered is that the secret to the US sort of dominance globally is on the back of global trade, and it's on the back of effectively free trade. And the fact that most goods and services were traded in US dollars. If you think of the most traded commodity, which is oil, it's priced in dollars. So any country, even if you've got China trading with South Africa, we don't pay in renminbi or yuan in terms of our payments. We pay in dollars. So, and that's why China, by default, has had to, the second biggest holder of US dollar currency is China, outside of the US. And that's why they take those dollars and buy US treasuries. So whether the US likes it or not, they've benefited massively from global trade, because all trade that happens, even between Europe and China, anybody and China, everything was priced in dollars. So the US might not be a counterparty to the trade, but they benefit because the trade happens in dollars. So the demand for dollars goes up, and that's why the currency of the dollar has been so strong. And we saw our rand has gone from 6 rand like 5-6 years ago to almost 20 rand. So what Donald Trump, and I hear you in terms of the art of the deal and, walking back, the reality is that global trade is a very complicated thing.
Yeah.
So on the 2nd of April, Liberation Day, when he had, the tariffs, all they did was basically take the exports divided by the imports, multiply by volume. Now that's standard 2 or grade 4 maths in terms of, so it's very unsophisticated the way he approached the tariffs. And the big thing that he missed out is services. So if you look at the US, if you take services into account, the US is actually the world's biggest exporter. They export more services than they import goods, because it's what they call a tertiary economy. So again, it's a long answer to a short question, but in reality, this weekend's talks, if it goes well, it's unlikely to walk back to the 1st of April, where we were, for 2 reasons. Firstly, confidence has been shocked and has been severely shaken globally. And secondly, even if he walks back some of the tariffs, remember his mandate when he got MAGA and when he got the mandate from the American sort of 20-odd million people that voted for him, massively part of that was attacking tariffs and attacking sort of global trade. And his justification is saying that the US is running these massive deficits. It imports more than it exports, and as a result, he needs to rectify that. So in a way, he can't lose face with the American public and the voters that voted for him, because in a year's time, 18 months' time, there's the midterm elections again. So if he can't get this thing right, which was his main sort of campaign promise, then, that's going to be a big slap in the face for him and to his voting public as well.
Yeah, Abdullah Aziz, I'm sticking on the tariffs and the impacts. Your presentation makes note of the fact that the tariffs isn't something new.
Yeah.
Something like this happened in the 1930s with the Smoot-Hawley tariff.
Yes.
Have we not learned anything from history?
Yeah.
And are we seeing similar risks today?
Yes, that's a very good point, because again, our research, we went back and looked at the Great Depression. So if one looks at the Great Depression, so this is a bit of a history lesson, and I'll try and be very brief on it. We had the 1914, 1917 First World War. After the First World War, there was a massive reconstruction and rebuilding phase where the world needed to reconstruct. Mainly Europe and partly, sort of Asia. The US wasn't really involved in World War I. So those countries needed to reconstruct, so they started running deficits. And then also what then happened is, because most of the able-bodied men were killed, they needed to get labor in. So that's when imported labor started. And then also the key to that was also that a lot of countries that were not affected by World War I were in a much stronger position to export to the weaker countries. So you had this very skewed global trade that started to happen, which was okay until the 1920s. So for 5 to 10 years, that was sort of the global trend and theme. In the 1920s, and the rise of Hitler and what's happening there, and part of the rise of Hitler is almost Trumpism in terms of how he came to power. Because again, those inequalities, the fact that German indigenous people were not being able to get jobs, according to Hitler, a lot of the Jews were taking the jobs and they were coming in and all of that. So again, the very seeds that drove Trump to power is exactly the same stuff that got Hitler elected and into power as well. But we got to a point where in 1929, the world was in a very skewed position because, especially places like America. America was importing a lot from China and from elsewhere. And we had the situation where the world was, very skewed. So these two Republican congressmen, they said that, look, we needed to defend jobs in America. There were too many, because remember at that stage you didn't have controls on migration. So the Irish were coming to America, the Europeans were coming, they were fleeing, a very dire situation in Europe. So all of these migrants were coming in. And they were coming with their connections in terms of imports and all of that as well. So they wanted to impose, there was 20,000 goods, if you look at the slides again, 20,000 goods that they imposed these tariffs, between 30 and 40% of tariffs. But actually, yeah, I think this is just a timeline from Trump that we spoke about earlier. If you look at, I think the next slide. So yeah, the 1930s. Before we get there, if you look at the 1930s, after that, the Great Depression, we saw the massive decline in global trade. Again, US-China, that was the big direction of trade that happened at that stage. But that exacerbated the impact of the Great Depression because two things happened. Global growth slowed down dramatically because now, if you think about it, if we import mics from China, and now overnight we say, okay, we're not going to import mics because the mics has gotten too expensive, double the tariff. We need to manufacture it locally. It's going to take us at least 2 years to get the processes in place to start producing. So that has a negative impact on global growth. But what it then also does, it becomes inflationary because people will still say, okay, instead of investing and taking 2 years, we'll still buy the mics even though it's 100% more expensive. So that drives us a phenomenon of what they call stagflation. Stagnation from a growth point of view, but higher inflation. So that's the stagflation element. And some of those, we are already seeing the elements of it. If you look at the last GDP numbers out of the US, the economy actually contracted. And the main reason for that is that there was a lot of this preemptive buying that happened. So in how they calculate GDP, GDP is all the goods and services produced in the country, and they subtract the imports. So when the imports spike, the subtracted amount is greater than the value of what is produced in country. So that will likely reverse in the second quarter, but that's a symptom of what's happening, is that growth, there's a dampener on growth, but inflation goes up because of tariffs as well. So the conclusion, to answer the question, the big learning for us from the 1930s is that tariffs are bad news all around because it reduces growth and the ability for economies to grow, but it also results in high inflation. Because guess what? Who pays the tariff? The consumer pays the tariff. The money goes to the government. What they do with the money, obviously, as well as Mr. Musk is going to do in terms of the Doge, and already I think he's been fired from that position. But, once it goes into a big pot, you don't see the direct benefit of that. So in conclusion, just to terminate on the tariff and the impact from the 1930s, our research shows that the big negative is that it knocks in consumer confidence. Also, what will happen is that from the 2nd of June and the 1st of July, when some of these tariffs start to get implemented, you are likely to see a significant drop-off in consumer spending. So growth will be lower, but inflation will be higher because the tariff will make everything higher as well.
And I might be completely, just speculating here. And, kind of my view on this is that the reason why, and, maybe you can provide some input here. The reason why Trump and his team are so focused on bringing manufacturing back to the US, having people build plants. NVIDIA is now building a plant. I think it's one of the major car companies also building a plant in Arizona. One is 100 million, the other one is 100 billion, the other one's 500 billion. Interestingly, they say they're going to build these plants over a period of 4 years. So I don't know if they timing, they have the timing in place there. But you talked about history, and you talked about World War I, and you talked about World War II. And the other thing that you said is that the US is the biggest exporter in terms of services, right? But when we look at China, and also if we look at, let's say, the Russia-Ukraine war, this NATO, they've been putting their weapons into Ukraine, but they couldn't push Russia back, and that's because of Russia's ability to produce weapons and the also the technology, in terms of creating. We're talking about the Houthis that now recently breached the Iron Dome. So supersonic weapons, hypersonic weapons, right? And the ability for China to also produce these at mass scale. Right? Now the US is exporting services. Doesn't it seem, to me it seems like if the US is planning to ever challenge China, not only from an economic standpoint, but also maybe potentially from a military standpoint at some point. They need to bring manufacturing back to the US in order to, as in World War II, where they could convert the car manufacturing plants into producing tanks, for example. So one of the reasons why the US were able to, it's not something that I've read, was able to do so well in World War II is because they were able to produce so much more tanks, where the Germans were producing very well the tanks were of much better quality, but the US tanks were cheaper, but they could produce way more. So when it comes to...
Henry Ford had a big role to play in that.
Absolutely. So is this maybe what Trump and his team are thinking about? I mean, this is just me speculating, but
look, I think he's speaking to a voter sort of constituency. If you look at the voter constituency that he's appealing to, it's white, blue-collar, middle America. And those people have been at the... Look, they're not unemployed. So this is a very important point, because if you think of the average blue-collar worker in America, typically 30 years ago, they were working at IBM. They were working at, a computer company, Toshiba, and these Chinese or Japanese companies that came into America. And they lost their jobs for two reasons. They lost their jobs because of technology and the advances in technology, or they lost their jobs because the production of those things moved to China. Now, that is what he's looking to address. But let's look at the other side of the equation. What happened to those people? Sure, some of them ended up flipping burgers at Burger King. But some of them have ended up being upskilled. They become Salesforce people. They become, service agents. They even become truck drivers. And I mean, here's an interesting stat for you. The average truck driver in America, guess how much they earn? $170,000 a year. That's over 3 million rand. That's more than what we earn. I can tell you that. So, and that's just for driving a truck. So the reality is that the average middle American is not doing badly for himself. They've been able to, the way their mortgage market is structured, they were able to buy houses and fix their mortgages for 20, 30 years at very low interest rates. So I think, to answer the question, yes, he wants to bring manufacturing back to America. But in my view, it's regressing. Because if you think of the evolution of an economy, you go from a primary economy where you're cutting wood or mining coal. South Africa, we're still in that sort of sector, where we then you mine the raw materials or natural resources to export. The second stage is where you beneficiate it. So instead of just selling the timber and selling the coal, you start producing products. You tables, or you produce sort of metal. If you take steel making coal, you produce steel from it, like what India is now doing and what China has been doing. Taking it a step further, and this is where America has been for the last 20 years, is that they say these are primary services. We give it to people in countries that are actually good at producing that. Let's be the thinkers. Let's be the designers. So if you look at your iPhone, it says designed in California, manufactured in China. So you want to be in what I call the sweet spot of a global economy, where you are the brains, you are the thought leaders in terms of product development and innovation, and the mundane stuff you outsource. He now wants to bring the mundane stuff back to America. Now, guess what? I'm sure you've seen those memes out of China where they show these factory workers, American factory workers. The reality is that the average American, as I've just said, $170,000 for a truck driver. That guy's not going to give us his job to work for $5 in a sweatshop to produce the same widgets which it costs China to produce. So the reality is that ship has sailed, and it's actually... From a ship, they've become a yacht and a speedboat. Now he wants to go back to the ship. It doesn't make sense. I can see the rationale in terms of bringing manufacturing back, but that's why I say, if you look at the US economy holistically, it's a much more services-oriented economy, and that's what the strength of the US has been for the last 20 years. Now you're undermining all of that because you undermine confidence in those companies. As I said, people are taking billions out of those companies and investing it back into Europe. And effectively, the key to the US competitive advantage, you're effectively undermining and eroding as a result of this.
That's a lot.
Sorry, man.
No, not. I mean, in terms of the information, in terms of what's happening currently in the market. And that being said, I have to ask, so how should investors reposition their portfolios to minimize the risk or even capitalize on any opportunities that they may be?
That's what we're grappling with, because it's such a fluid situation. I mean, in January we spoke about the Mag 7 and the strengths of them. You take companies like Microsoft, for example. The strength of Microsoft is in the product development. The actual, like even now, I mean, I remember when I started out, you get a Microsoft floppy disk or a hard disk drive. They don't even make that anymore. It's like a key, you just punch in the key and then, so there's no real hard assets for a company like that. It's all services and it's all innovation. Now, for a company like that, at times it's the most valuable company in the world. And guess what? It's all built on technology and technical ability in terms of innovation. And this is what Mr. Trump is not appreciating at all. So what we are seeing is that, in a way, the world is taking a step back. And companies... So Microsoft had a massive valuation. It was rewarded with a high valuation because of that element. But that's the very element that Trump is now attacking, and that is now eroding. And that's why we're seeing all of these companies. Microsoft is down about 20% year to date. NVIDIA is down about similar as well. So the share prices are coming down because investors are saying, hang on, the secret to their success, the tailwinds that these companies have enjoyed for the last 5 to 10 years are now actually at risk here. And instead, what we're seeing is that Europe is focusing on their own companies. They're saying, hang on, we can't just depend on America. You talked about defense earlier. A lot of European countries are spending 1 to 2% of GDP on defense. Mr. Trump is telling them, you need to get to 5%. All of them are now doubling their defense spending. What's going to happen is companies in those countries are going to benefit from that spend. So the old economy stuff, the guys that are producing steel, the guys that are producing... You take a company like Henkel, for example. Henkel is 140 years old. I'm sure you've seen Patex and Prit and all of those. These are the companies that are going to benefit from countries refocusing and saying, hang on, we're going to go back to manufacturing processes to benefit ourselves. And so we're seeing, in January I spoke about the waterbed effect and the fact that these Mag 7 has done well and all of these things have been depressed. We are seeing a rebalancing happening in the world today, where the old economy stocks, because there's reinvestment happening in those sectors that will benefit those companies, are seeing better growth than these high-flying stocks that have done well for the last 5 to 10 years.
Abdul, I was just thinking about some of the things that you were saying earlier as well, and really focusing on, I think, the big theme now, and what I'm hearing you saying is that investors are losing confidence in the US. Before it was a given. You invest into the US, put money into the S&P 500. Invest for the long term. About 60% of your portfolio goes there, and you'll be okay. But that now is in question, and that's really very serious. So on top of that, you also talked about the treasuries that are being sold off by the Chinese government, and then at the same time with the gold price now shooting up. Currently, I mean, within the last month, I think it moved from $3,000 to $3,400 dollars an ounce. Massive movement. So with that, how not only in terms of investments, but how do you see this playing out? Because really, I mean, this is just a massive change in the way the world runs.
Yes. Look, the one reality, and part of why people are losing confidence, is that we're still in this first 100 days. So he still has another 303 years to go. So the reality is that the politics have overshadowed the economics. And again, one of the learnings from the whole tariff debate from the 1930s is that economists, the global agreement on tariffs and trade, the GATT agreement as they call it, gave rise to the WTO, the World Trade Organization. All of that, those checks and balances were put in place to avoid this Trump sort of tariff sort of scenario. So it shows that global institutions are failing as well. I mean, we see that in the political and socioeconomic sphere with ICJ and criminal hearings and all of those things. But similarly, on the economic side, sanity. I mean, you've got Harvard, you've got, these institutions with the best brains in the world, and yet they can't advise their president that he's making stupid decisions. So for the rest of the world, we're all looking at this and saying, wow, this is astonishing. And that's why we're seeing this loss of confidence in the US, because it's not just a Trump phenomenon. It's been brewing. Remember, this is his second term.
Yeah.
So it's not like it's a test case, or people willingly and knowingly and with open eyes voted for him. So there's a failure in the American sort of system in terms of not only the electoral processes and democracy, but also how it translates into economic sort of ownership and dictatorship. So I think that is where the confidence has been knocked. And that's why I say it will take years to repair. And so that mantra of buying the S&P and leaving it in your bottom drawer and looking at it at 10 years' time, that is at real risk. I mean, I'll give you one example. The pharma companies in the US, they're all under threat now because he's likely to put tariffs on that. But in addition to that, you've got a new guy in charge of the FDA, for example, that he's got very different views on vaccines and all sorts of other things. So that means that the traditional processes around pharma and pharmaceuticals and product development is also at risk. So if you're a CEO of a company, either in the pharma space or even the IT space, you typically want to make plans for the next 10 to 15 years. You can't in this environment. It's almost like where South Africa was, pre-94. You can't make long-term decisions because it was such an uncertain environment. And I think the US is now in the same space because the political and democratic process is so uncertain. You don't know if you can make plans that will survive this current administration, or whether the administration that will succeed it will be better, given just the dynamic in the US as well. So I think that loss of confidence, and we're seeing it on the consumer side as well. So consumer confidence has also been knocked because they feel that if they can do this to household goods, like the average car in America is $4,000 more expensive overnight. So people are, you in that realm where Japan was in the 1980s, where because house prices were going up so much, this aspect of rising inflation also meant that they started to save, because they said, if I want to buy something now and I can't afford it now, in a year's time it's going to be actually much more expensive. So I need to save even more to be able to buy it then. So we're in that sort of reality now, which I think is very unfortunate, because it makes the world a much more uncertain place, unfortunately. Yeah.
Abdulaziz, part of your presentation, you highlight the Sharia-compliant opportunities. And what you highlight in fact, is Omnia.
Yes.
Strong growth.
Yes. Yeah.
What makes that a standard Sharia-compliant investment? And in which sectors within Omnia are showing the strongest growth?
Yes, a very good question, because the big themes that hasn't changed for us globally is firstly sustainability, is environmental impact. It's the fact that the world is increasingly we've got population growth. The amount of what is called arable land, or land that you can farm on, is shrinking and diminishing all the time. So those are big themes, and what we try and do in our portfolios. I mean, there's another company called Nutrien, which is the world's biggest potash producer, and potash is quite critical for yield increases in terms of farmland. So similarly, I mean, the big theme for Omnia, and what I personally find very attractive in Omnia, is that they've got this product called Humates. So Humates is like, so in Australia, which is the world's biggest sort of natural reservoir of Humates, what they've actually discovered, I think in Queensland, the Queensland state, is that because of the coal mining is massive in Queensland, they discovered that below the coal, there's actually this substance called Humates. Okay. And it's a fairly recent discovery.
Yeah, they're calling it the wonder product.
Yes. And what Humates then does is, it's basically like, if you think of a saline, salty type substance, it actually blends very well with your normal fertilizer. If you do farming, you would have heard of NPK, which is basically your nitrogen, your potash, all of the ingredients that goes together to make fertilizer. Okay. So Humates actually boost your fertilizers in terms of getting better yields. It also is it's a lot more efficient in terms of just a bit of humates reduces the amount of other fertilizer you require. And so the bang for buck is quite clear. And Omnia, I can't remember how they managed to get into that, but almost by accident, they stumbled on this product. But they are now the world's biggest sort of producer of this, because what they've done is they've signed these contracts with these coal producers. So as the coal guys go in and get the coal out, they then there to scoop up the humates and then just basically package it. And recently they've started supplying Brazil. They're now looking at contracts in China. So we think that this market is fairly nascent and the opportunity is massive for them.
Yeah.
And you're not getting, I mean, if you look at Omnia, the traditional Omnia business is basically these chemicals that they do for the mining industry. They do a bit of explosives as well for the mining industry. This thing is almost non-existent in terms of the valuation or the cash flows of Omnia. So it's a real opportunity, which I think can be half of the business in 5 to 10 years' time. And
wow, that's amazing. I remember with Omnia also, they benefited quite a bit from the war in Ukraine, because I think previously a lot of the pontage used to be imported into South Africa, so they obviously benefited somewhat from that. But just on that, I think before we get into the kind of the local side and talking to the local piece, I just want to touch a bit on the oil price. So OPEC Plus has now kind of increased the production, driving down the price of oil. I think it was sitting at something like $57 a barrel. To 62, it's back up to $62 a barrel. But anyway, at about $60 a barrel, it becomes quite difficult for some of the oil producers to dig, especially from the American context. How does the oil price, let's maybe bring it back to South Africa or globally, benefit us from an inflationary perspective? And also, where do you see that going?
Okay, very good question. So where we are currently in the oil market is the best barometer of growth. So if you look at COVID and the COVID pandemic, when oil prices in America briefly went negative and the oil price, went down to $30. It was basically because growth stopped. And like I said earlier, the biggest traded commodity in the world is oil. So if global trade falls and becomes lower, oil prices, you see it immediately in the oil price. So we think that where the oil price is between, say, $55 and $60, it's an indication that the world is actually not growing and actually contracting. If it goes above $60 to $65, then we're sort of flatlining, and above 65, it's actually quite a robust growth environment. For South Africa, because we're a net importer, it's massively beneficial for our inflation. So oil prices, and even the rand, where it's now 18.25, 18.30, our inflation will be very, very low. So that's a massive positive. So it gives the Reserve Bank scope to maybe reduce interest rates further. The US is also, so the US is interesting because the US at the moment is the world's biggest oil producer. And what they do is they actually export what is called the condensate product. So the US, whilst for the local guys, they'll benefit from lower oil prices, but it actually hurts the US in terms of their revenues as well, because now they're getting a lower oil price in terms of their revenues. And from an OPEC point of view, I think the reason why OPEC has done this is because, look, OPEC as a creation is basically a cartel that is there to try and regulate the price. But at times when they see that the price can't be regulated because of global economic factors and growth slowing down, they just give up their mandate and they say, okay, just flood the market. Because remember, it's a volume-price relationship. If the price falls, you want to sell more, you want to produce more to offset the price decline, to try and keep your revenue line the same. So we're in that realm now where OPEC is saying that we don't anticipate that we'll be able to control the price from falling. So let's just control what we can in terms of volume and just increase volumes, which further exacerbate the price weakness. But at some point, what it also does is the high-cost producers then fall by the wayside. So in the US, our research shows that the US shale producers need at least $65. And like I said, the US being the biggest oil producer at the moment, 13 million barrels a day, which is a lot. I mean, Saudi does about 9 billion barrels. Russia pre the Ukraine situation was sitting at about 11 million barrels a day. So where the US is now at 13 million, they are the world's biggest producer, but a big part of that is coming from shale, which is higher cost than the traditional sort of, Texas oil, for example. So you're likely to see a situation where the oil production side decreases, and then the oil price goes up slightly, probably between $62 to $65, and will probably stay there for the remainder of the year.
Okay, excellent. I think for Abdulaziz, we want to thank you for the market update.
Yeah.
Maybe just to end off with, maybe you could just give us maybe just a general summary.
Yes.
Of all the things that you were saying, because there was a lot to unpack there, and also maybe just I think with when we have you on again, we'll maybe ask you for a stock tip. But for today, I think let's just end it off with a summary.
Okay. I think to summarize in 2 sentences, and hopefully the stock tip is Omnia. I mean, hopefully I've demonstrated that people must go out and buy Omnia. But
it's trading at a discount. Well, compared to others.
Yeah, but I think the summary is that for people that are investing and people that have money to invest, now is as good a time as any to invest. For the simple reason that we are living in a very uncertain time, and hopefully we've demonstrated that these uncertain times also create opportunities as well. And our job as fund managers, as analysts, is to look back at history and learn from history. Because the biggest mistake you can make in markets is not to learn from history and not to learn from others' mistakes. Because that's how you actually grow. I think to bring it back religiously, Imam Shafi actually said his biggest learning is to learn from other people's mistakes. Because and it applies to investing as well. So I think for our investing public, we're getting a lot of phone calls. People say, what's happening in the markets? I say, it's uncertain, yes, but we've got a formula that works. We've been around now for over 25 years in terms of our first products. The company's around over 20 years, and we've seen these movies before, global financial crisis, COVID crisis, all of that. And human behavior doesn't change. In times of panic, people sell, and in times of optimism, they want to buy. So we're in that time now where there's panic, but now's the time to buy. Be counterintuitive. And I'm a firm believer that, for the next 5 years, whoever puts in money in the market or whatever, I'm not saying buy our commercial products, whatever you buy, obviously do your homework. But I'm firm of the belief that in 5 years' time, you'll be in a better environment. Simply because we are in the age of, I don't want to say enlightenment, we are in the age of AI. So information gets disseminated quickly. And we're seeing the real world impact of decisions immediately. And nobody's out there to lose money. Nobody's out there to make a mistake. And we can learn from our mistakes much quicker. Imagine we didn't have social media and Facebook and all of these things 10 years ago. We wouldn't know what's been happening in America. We wouldn't know what's happening in China. So, sorry, it's more than 2 sentences. But in essence, I think because of this information is power. And that gives us the sense that, we can make the right investment decisions with a much broader set of knowledge and information. And as a result, client outcomes would be a lot better as well. So I'll leave it there.
There you have it, guys. Information is power, and that information is only found here on the Campus Dialogues. So if you like this video, please give us a thumbs up, leave a comment, hit the bell icon, and Assalamu alaikum wa rahmatullahi wa barakatuh.